Investors are hungry for a piece of the AI boom, and our next guest helping retail investors get in before AI companies go public. Joining us now, Fundrise CEO and co-founder Ben Miller. Fundrise is an online investment platform that offers retail investors access to private real estate, but suddenly, more recently, private AI companies like Anthropic and Canva. Through its innovation fund, Willie Sutton, I guess, you go where the money is, right? So it was real estate, private real estate. You want to get in on some of this other action.
Yeah, I mean, we basically have a couple million users, and we've been democratizing private markets for about a decade. And we saw a dramatic shift in retail investor behavior.
With AI?
With AI, yeah. I mean, last year, people were mostly in high-yield checking accounts, fixed income. And in the last couple of months, there's been this radical shift towards equities, towards AI. All of our survey data, all of our investor behavior is telling us that they want more AI. They want to invest in the rising tide of AI. And so we created an innovation fund, which basically is a first ever. It's like a public venture fund that tears down the barriers between private and public markets and democratizes access to private tech companies.
We remember the meme stock craze and Robinhood and what happened to the stocks, like Robinhood itself, as well as the crazy behavior of some companies that was the potential ever really where the stock prices went? I don't think they could have never grown into the potential that we saw. And so I'm not going to mention any names because I don't feel like getting bombarded by Twitter, because they're still around. They're still holding these stocks that are worth, what, 2 cents on the dollar?
Go ahead, say some names.
I'm getting closer. But you've been waiting for something. AI is now, the baton from meme has been passed now. It sounds like the speculation has been passed to AI stocks and maybe crypto.
Yeah, well, I mean, venture capital is the best performing asset class in history. And before we launched our innovation fund, ordinary investors could not invest in venture capital. So there's obviously risk, but what's happened with the market structure is that private companies are staying private longer. And so you have these behemoths, these massive multi-billion-dollar companies that are still private, that investors should have access to.
You're real estate. You're experts in real estate. So if your expertise was real estate, when were you found? How long were you doing real estate? Letting people do this? How long was it?
A decade.
A decade. Suddenly AI becomes very hot. Now you're experts in AI, at least remember when everybody would add a .com to their name? Is it similar to that?
Well, so we have 150 software engineers at the company. We have a couple million users. We have the full stack in terms of technology.
It was an easy transition.
So I've been building software for a long time. My first-hand experience in finance and in technology is pretty deep. And so it was actually the most natural, is where our expertise sits. It sits at real estate and technology. And then the timing just was fortuitous because private markets had repriced down to more reasonable levels. And then there's been the sort of, I think, the greatest technology breakthrough of my life. And so investors should be able to participate in that. And before us, they couldn't.
Right.
What kind of diligence do you do that's somehow different than anybody else?
Well, so our fund's registered with SEC, so it's a publicly registered fund. So, and then we are like another venture fund. It's a fund, and we diligence companies. We have a team we hired from ex venture capital companies, and so our process looks like any other venture capital diligence process. We focused on the more mature companies that were pre-IPO. Like, if you remember, Goldman Sachs did this with Facebook before they went public. Right. They did it with Stripe. Now we're doing it too. So there's a long history of basically providing access to people, and it just shouldn't be based only on net worth.
Right. So you don't think that the net worth category is a good idea? Clearly you think it's a bad idea.
Well, yeah, I mean, you're talking about venture capital, these companies, if I look at our portfolio, these companies have $1 billion of revenue, or more. They're all very mature. There's no reason that they from a purely fundamentals point of view, these companies should be barred from ordinary investors.
Right. The reason why this has been the case for so many years is because people will look at an FTX or they'll look at They'll look at a company that, by the way, people thought had great revenues, and by the way, many of these companies still don't have profits, including many in your portfolio. And they'll say, what's going to happen to this company? And most importantly, can they really be diligenced? That's why I asked you the diligence question, because if you talk to most venture capitalists, they'll say, actually, we're really not in the diligence business, to be honest with you. We're in the business of investing in 30 businesses. We expect that some large portion of them actually going to go to zero. How they get to zero is actually less relevant to us. So we're not like spending all day long trying to figure it out, because some of them are going to go to zero, and we know that. That's a different model when it comes to the public investor than maybe somebody who has a high net worth who might be able to absorb that kind of loss. That's the reason the question, I think, is being asked. Yeah,
I mean, I get the question. So venture capital as an industry has evolved over the last couple of decades, and you're talking about a huge asset class, something like $500 billion now. And so there's a spectrum. There's early stage, right, that basically you're making bets, and then you have late stage. Companies have hundreds of millions in revenue. They have thousands or tens of thousands of customers, and so we focus on the late stage. I think the late stage should be accessible to individuals, and there's I think a very manageable risk profile compared to, you're betting on three guys in a garage. That's risky.
AI at the point where it is right now, I don't know how you compare it to .com, but how many are going to be survivors and how many are going to be the magnificent seven of the future? That's what I would worry about. Most of these, how many pets.com are there around in AI right now?
Yeah, right, for sure. I mean, there's likely to be a boom and a bubble. The research we did, basically, we looked at all of the past waves of technology, PC, mobile, internet, cloud, and it looks like AI is likely to be about a $15 trillion market, by the early 2030s. So that's a huge amount of wealth creation. We've already seen the video go to $2 trillion. So the question is that wealth creation going to accrue to the top 1% and we'll have both AI and massive wealth inequality, or will it be more evenly or fairly distributed? And that's why you have a fund portfolio. You have a diversified portfolio, so you have some of the big companies that are really established, and then you obviously have some companies that are more risky and likely to see losses.
Look, I think this is a really interesting opportunity for some people. My question is going to be about fees. What kind of fees do you put on top of this?
So our fees are much lower than a normal venture fund. Normally, venture funds charge 2 and 20, so 2% asset management fee, 20% carried interest. We just charge 1.85% asset management fee, no carried interest. So the carried interest is how venture capital,
right?
That's how they get rich. Basically, it's a great business.
Right.
So by eliminating that, I think.
How are you going to get rich then?
Our model is basically a low-fee model. We've always had a Vanguard ethos, which is basically if we can broaden access, use software to lower the marginal cost of each investor, right? Our investment's $10 minimum, right? How do you do that? You do that with zeros and ones, with bits. And so software can basically lower this cost like it's done with all of finance, right? I mean, the cost of stock trading used to be really high. It's fallen. So this is basically a long arc of financial history towards democracy.